Welcome back. Analysts say it's not going to be easy for South Africa to avoid further downgrades that may burden the economy with higher borrowing costs. This follows Friday's decision by S&P Global to downgrade its outlook on South African government debt to negative from stable. On Wednesday, the RMB BER Business Confidence Index for the fourth quarter of 2019 will be released. And on Thursday, producer price inflation for October will be released as well by Stats SA. And on Friday, S&P cited the country's low growth environment, widening budget deficit and rising debt levels as damaging to the fiscus. The leading indicator, which offers a projection of South Africa's economic growth cycle for the next 6 months, has been contracting for the past 11 months. However, market expectations are that it may increase slightly in September, with that data expected to be released tomorrow. In the third quarter of 2019, the Business Confidence Index plunged to 21 points, a 20-year low. Producer price inflation continued to slow in August, reaching 4.5% year-on-year, down from July's 4.9%. It's predicted to continue to ease in October to 3.1% year-on-year, according to a poll by Bloomberg survey of economists. So let's take a look at some of the market highlights following the decision of rating agency S&P Global to change its outlook on South Africa's sovereign debt credit rating from stable to negative. It was citing ailing growth and government's worsening fiscal and debt trajectory. For more on this, we're joined by Maudi Lentsoane, who is Managing Director of Lehumo Capital. Maudi, welcome once again to our program. Are we really going to see government coping with avoiding further downgrades, or is it just going to be a free fall?
Look, I think to avoid the downgrade, Colin, it's going to be a very, very difficult job to do. It's almost an impossible task, if you ask me. You've heard from Moody's last month. Now you've heard from S&P. They're all talking about the fact that things are not looking good. It's almost a foregone conclusion, unfortunately, that we are going to have Moody's now downgrading, because when you look at what S&P has done, it's threatening to now move us even 2 notches below that junk status. So that means Moody's will really find it very difficult as to why they're keeping us in an investment grade when the other rating agencies are already 2 steps below that investment grade. So it's going to be a very difficult one unless we really perform miracles between now and when they do the further review, which is around March, I think, next year.
So that miracle, I mean, where will it come and how will it come about when we're having companies retrenching, the government is having a shortfall in revenue collection, things seem not to be looking good? It's
a very tight space to really operate in. When you've got the SOEs, the South African Airways still also asking for, wage increases that are well above inflation. A number of those things, those are the areas where I think we should really be focusing on and saying we're operating in a very difficult space. Everybody should make compromises and not ask for these wage increases that are going to further put pressure. That bailout that goes towards SAA really literally just goes into financing a portion of that wage bill. I know that they've worked it out such that it's not an immediate increment, of 8%, but it still has a negative impact if you look at it. So those are some of the areas. But I think we're running out of time. We do need to begin to turn things around. Let's get those investments that have been pledged to come into implementation. We've implemented very few of those that were pledged last year. So hopefully we fast track that and begin to really implement some of those pledges so that we can turn the situation around. The debt to GDP threatening to reach 80%. That's what the rating agencies are really looking at and very worried about that. All
right, so a quick one on Tiger Brands. They've been making losses for the past 5 years on the African continent, especially Nigeria. Now they want to go back. Is it a wise move, and how do they guarantee that it's going to be profitable in the midterm?
Yeah, so Tiger Brands, is struggling. It's not only on the African continent, but it's also struggling here at home. Low demand, consumers are under pressure. The economy is just not growing. But yes, you mentioned the Africa move, which they got horribly wrong previously when they went into Africa, into Nigeria. The Nigerian market has been one very tricky one. Some few companies, South African companies, that is, got it right. Some have got it, they got it completely wrong. MTN will tell you they They're licking some few wounds. Tiger Brands were also some of the companies that licked their wounds. Perhaps they've got a different approach, and there are some, markets in Africa which I think can really offer that opportunity, especially with the Africa free trade that we're talking about. The fact that Africa needs to start working together, I think is a strategic move for them that, if done properly, can actually work better for them.
All right. Okay, thank you very much. There's so much to talk about concerning what's happening in the markets, but also this is to be continued.
Thank you very much.
All right. Maudi Lentsoane is Managing Director at Lehumo Capital. And back to Palisa.